Hello, viewer. Welcome to yet another episode of the First Time Homebuyer series. In this episode, we will talk about insurance aspects which are touched upon in step number 6 and number 7 of the home buying process. As you all know, I am a mortgage agent and not an expert on insurance. And that is why today I have brought in an expert who will enlighten us about this topic. So, with that, let me introduce you to Sandeep.
Hi Neil.
Hey, Sandeep, welcome to this episode. And thanks for taking the time out to speak to me on all things insurance. But before we get into the insurance aspects of the discussion, could you just maybe share a bit about yourself?
Sure, Neil. Thanks for having me on your show. And hello, viewers. I am Sandeep, and I am a licensed advisor. I am an expert on advising customers on financial literacy. And I'm very excited about the topic of today's episode and look forward to educating you on the basics of insurance in the context of buying a home.
Thank you, Sandeep. So, viewers, just to set the context about where insurance comes into the play, imagine that you have placed an offer on a house and the offer has been accepted. Working with a mortgage agent, you have also secured a commitment from the lender on the mortgage and are waiting for the closing date. In preparation for the closing, one of the important things that you should arrange for is insurance. This is because while your new home is a real estate asset, you need to make sure that you are protected against any damages to the house as well as damages to yourself and your family. So, with that background, I will request Sandeep to take us through the details.
Sure, Neil. So let's start off with a review of all risks associated with being a homeowner. First risk has got to do with damages that can occur to your property or home from fire, flooding, accidents, burglary, or any such kind of incidents. The insurance protection available to safeguard you as a result of such damages is called homeowners insurance. Lenders require home insurance cover to be purchased before the mortgage is closed and then being named as beneficiary. This is to ensure that their mortgage or investment is protected. I would recommend that you have a home insurance even after you pay off your mortgage because repairs can be quite expensive. Another aspect worth mentioning is that if you obtain both auto and home insurance for the same insurer, then most can extend a notable rebate or a discount.
Um, Let me talk about the second risk. The second risk has got to do with borrower defaulting on a mortgage. The protection available to the lender is by means of mortgage insurance, and it is mandatory in Canada when purchasing a home with less than 20% down payment. The borrower pays for this insurance and it protects the lender. There are three companies which provide mortgage insurance in Canada, them being CMHC, which is a Crown Corporation, Canada Guarantee, and Genworth. Please work with your mortgage agent to determine which of these insurers might be suited to you, as not all will be following the same guidelines come 1st July 2020. Please reach out to me in case you have any queries.
I'll take you along with the third risk, which has got to do with borrowers being incapacitated to pay mortgage, either because of an untimely death or grave illness or a disability. There are protections available to the lender and or borrower based on choices pursued. This could be mortgage protection insurance, life insurance, disability insurance, and critical illness insurance. Let's take one insurance at a time. So we'll go with mortgage protection insurance. It's basically different from mortgage insurance discussed previously, as it's a type of life insurance. And it covers the outstanding mortgage in case the borrower dies or becomes disabled. Banks generally try to sell homeowners this type of insurance when they sign up for a new mortgage. And mortgage agents are required by regulation to offer a third party product to the borrower. Let's go to the next one related to life insurance. So, life insurance provides an infusion of cash for dealing with adverse financial consequences of the insured's death. It enjoys favorable tax treatment unlike any other financial instrument. Death benefits are generally income tax free to the beneficiary. So, just for your understanding, there are four types of insurance. One is term insurance, which is the simplest form of life insurance. The payout happens only if death occurs during the term of the policy, which is usually from 1 to 30 years or up to an age of 65 years. Most term policies have no other benefit provisions. The insurance ceases once the term is over. It is to cover insurance needs that are temporary, such as mortgage or children's education. Next comes the whole life insurance, which is also called the permanent insurance and covers you for life. And there is an investment or cash value component associated with your policy. This is also sometimes called permanent insurance, as I said before. And as you pay into your policy over time, it builds investment value. You can actually cash out the value of your whole life insurance policy to supplement your retirement income or any other expense that you might have. In some cases, you can borrow against the value of a whole life insurance policy. This insurance usually has a higher premium since you are covered for your entire life. Then comes the universal life. It's similar to whole life. The only difference is where you have the control or option to invest the cash value. If you are an investment savvy person, you may find that universal life insurance is a more appealing one. However, this would mean a lot of hands-on activity and monitoring of your investments. So if you're ready for that, this is the best one for you. Another option is a group policy coverage, which might be available for a group of people, typically from employers. The cost of group health insurance is usually much lower than individual plans because the risk is spread across a higher number of people. However, here the employee has little or no control over the individual coverage, and it does not continue if you leave the organization. And most people need additional coverage to compensate for coverage not included in their group life insurance. So this is all about the life insurance, the types of life insurance. Okay, now let's see the benefits between choosing a life insurance product and a mortgage protection insurance from the lender. So what difference do we see here? Firstly, the borrower pays for both life insurance and the mortgage protection insurance, but here the ownership is not similar. The same applies to the beneficiary of the payout as well. In case of mortgage protection insurance, the lender is the beneficiary and not the borrower. Thirdly, the insured amount with your mortgage in the case of mortgage protection insurance, as it covers only outstanding debt, while insurance premiums remain the same. Fourthly, in case you switch lenders or renew your mortgage with another lender, then you will need to secure a new mortgage protection insurance, as lender supplied insurance is not portable at all. However, the key difference is mortgage protection insurance is underwritten post a claim has been submitted. This could result in the claim being declined if any discrepancy is found with the original application for mortgage protection. The one positive with mortgage protection insurance is that it would potentially be cheaper than an individual insurance policy, as the former is a group policy. Well, I know all this can be confusing and not all products are also similar. So it's important to consult with a qualified advisor regarding your insurance needs. You should not go without any insurance. Rather, you could go for a life insurance. With life insurance, your payout remains the same, which means that even if you have paid down your mortgage, your beneficiary can still get the entire coverage amount. There are no strings attached, as the underwriting is done at the time of the application. Moreover, if you are young and in good health, life insurance can be secured at a very low cost. So I think we have spoken about mortgage protection insurance and life insurance at a great length. Let's quickly touch base on disability and critical illness insurance as well. As you may know, both these protections can be obtained as riders or add-ons to your whole life insurance, or can be obtained separately as well. Generally, disability insurance replaces between 60% and 70% of your regular income, up to a maximum amount for a specified time if you are unable to work temporarily or are permanently disabled due to an injury or illness. Many employers provide disability insurance. However, you can claim the EI as well in case your employer does not provide the disability insurance, or you can get it from a life or a health insurance provider. The short-term disability insurance provides benefits up to 6 months, and the long-term benefit starts when the short-term ends or the EI benefits end. So let's look into the critical illness insurance now. They usually pay a one-time lump sum payment, which is tax-free. And if you're diagnosed with a life-threatening illness like cancer, heart attack, stroke, etc., this lump sum payment can cover your expenses. Normally, the policyholder must survive 1 month before the policy will be paid out. As I said, you can add it as a rider to a whole life insurance if you have one. Well, this completes a quick review of the various risks which come along with the home ownership and some means to protect yourself and your family towards any untoward incidents.
Thank you, Sandeep. That was an excellent overview. And thanks for sharing your expertise with our audience. Hope you would agree to come on the show in future as well. And I look forward to more valuable insights on all matters insurance. Thank you, Sandeep.
Thank you. Thank you for hosting me.
So viewers, hope you like this episode on insurance. As always, reach out to me at 647-905-5557 or email me if you have any queries. If you found this video to be useful, please do share this with your friends and family. And don't forget to click the like button. Thank you for watching, and I'll be back shortly with more useful information. Till then, goodbye and take care.